I'm live with Samuel Deane of Deane Financial, who is an expert in stock-based compensation. This is one of the most important topics right now for young people, young employees of startup companies, investors, founders of startups who want to be able to attract talent. Everyone wants to pay attention to this topic, and Samuel knows a lot about it. So stick around. We're going to get into everything you need to know about equity and stock-based comp. Okay, Samuel, thank you so much for being on the show. You and I met, I think, at like an ETF event or an advisor event. Where was that again?
Yep. So the first time we met was actually at WealthStack at your conference. And then we met again recently at Inside ETFs.
Samuel and I live like 10 minutes away from each other, but I don't think we can hang out anytime soon. We'll see. We'll see as our area reopens gradually. So you're a financial advisor, and you're doing a lot of work for people who are in the accumulation phase, and they're building wealth now. And a very important topic to that demographic is stock-based compensation. Why is that so important?
I mean, I think it's extremely important just because, equity compensation is, for tech companies at least, is an essential aspect of attracting, retaining employees, especially younger employees. 41% of at least the millennial generation's net worth is made up of equity compensation. 36% of them plan to use equity compensation to finance their retirement. And so, for me, it's obvious that stock comp in the form of equity grants allows employees to participate financially and benefit in their employer's growth. For me, I think ownership makes all the difference, when employees and investors understand what they own. They can really, take advantage of this wealth building tool. And so this was just something that I noticed in the tech space. My fiance is in tech. She's a product designer. And so I was able to sort of get an inside view on what that looked like. And once I noticed that opportunity, I just kind of went, heads on.
Okay. So a recent survey found that 57% of people under the age of 35 agreed that stock plan benefits are an important consideration when changing jobs. And that's versus 46% for baby boomers. So there's obviously something generational going on here. I think people in that 35 and under cohort have seen unbelievable amounts of wealth created in Silicon Valley, but also elsewhere in the country. And they say to themselves, that's what I want, And so I think there's more acceptance of being paid in shares of a company than maybe there were for prior generations, even though that means you're deferring spending now, right, as an employee. So talk about that trade-off and what you found from dealing with clients who are being paid partially in stock of a company they work for.
I think, for the most part, everyone wants to walk away from, the negotiation table with the feeling like they've won, right? And so I've had clients, just try to understand how to weigh one opportunity versus another when, let's say, a company's offering stock options, whether ISOs or NQSOs, or whether they're just offering RSUs.
What are those terms, ISOs and QSOs?
When it comes to stock options, there are two main types of stock options. You have incentive stock options, which are ISOs that have a little bit more tax benefits, and then there's non-qualified stock options. Stock options, RSUs, restricted stock, I would say, and employee stock purchase plans, I would say, are the main equity vehicles that I've seen. And when you're deciding between, these different vehicles versus your salary, the key, I think, is to win at the right things. After you've done your research, you take some time to determine what really matters to you. You could be a young millennial who is looking to purchase a home, and getting stock options and having to have that upfront cost to take advantage of them may not be in your best interest. What's in your best interest could very well be, receiving RSUs and selling them right away for cash to be able to put a down payment on the house. And so you really have to understand what matters to you in order to even make that decision.
Do employees often have the choice, or is it usually the employer saying, this is the format that our stock participation takes? You either want it or you don't. Well, what have you seen?
I think it really depends on the company. Nowadays I have been seeing companies offer ISOs, non-qualified stock options, RSU, restricted stock, and cash. And then that gives the employees the opportunity to somewhat select how, it gives them more control over their financial planning and more customization. And that's something that, I've enjoyed as well. As Uber's 2019 stock plan had that feature in there. And, Spotify currently has that. And so I've been working with a few Spotify employees and trying to figure out what's the best incentive mix for them. Spotify allows their employees to choose, two vehicles in 25% increments. So it could be 50-50, 75-25. And they offer in the money options, out the money options, cash and RSUs. And so that gives me the flexibility to really align the equity comp with what, our clients' goals are.
Okay, let's say I'm 30 years old. I work for Spotify and they present those options to me. And here's my personal situation. We're about to have a baby in our house for the first time. We just bought a house, so we don't need the down payment money. We did all that already. I have a nose ring, and I intend to stay at Spotify for as long as they'll keep me I love the company. So with those as like my factors, what do you tell me? Just take the out of the money option, or do you tell me take the restricted stock unit and just take it right now? Like, what would you generally advise somebody in that position?
I would say for most people, I think a mix between the in the money options and the RSUs are the best benefit.
Why the in the money option?
And again, I think it depends on the company as well. If we're talking about Spotify, they've seen tremendous growth over, the past, 2 or 3 months in terms of the stock price. And so I would say that the out of the money options is beneficial. It's funny. I was actually sitting with a client. I was asking him, he chose his incentive package before, he became a client. I was asking him, why did he choose the out of money options over the in the money options? And his reasoning was, pretty much just because he didn't know much about it. And his mentor told him that that was the best thing to do. And, I was saying to him that based on his risk tolerance, the in the money option and the RSU mix would have been best for him. And it turns out that, look at what's happening right now, right? And so now we're figuring out, well, what do we need to do? How can we come up with the funds in order to afford the exercise of those options? And that's another sort of nuance that most people, that it goes unseen most of the times.
Yeah. So in other words, I have shares in a few fintech startups, and they've been granted to me. I join a company's advisory board. So I don't work there, and I haven't, and I'm not an employee there, but it's a granted amount of shares because I'm serving as an advocate for them. Okay. So then the question is like, okay, I have 20,000 shares, just making up a number. Right now, the shares are worth $1 because it's a startup and nobody knows, what the future will hold for the company. Now, if I pay the taxes on those shares now, I'm paying them on $1. Let's say the company's wildly successful and the share price goes up to $10 because maybe Andreessen Horowitz comes in and invests, and maybe Benchmark Capital invests. And then I want to exercise them and sell them. If I wait on the taxes, then I have to pay it then.
Yep.
Right. I have to put up the money then. So that's a tough decision to make early on, because you almost have to have a bet in terms of what will this company's stock be worth, in addition to having your own personal situation to figure out, right?
I would say that the good thing about that is you don't have, and what you're referring to is the Section 83B election, paying the taxes at grant versus at vesting, at least for restricted stock. Am I correct?
Yeah. What's the right answer?
I think you don't have to do the election for all of your shares. You can do them for some of your shares if you don't want to make, that
right.
100% bet. So I think there's a medium right there.
Okay. So oftentimes you're explaining to people the different trade-offs between how they can handle this kind of compensation. And then you're going to have to blend sometimes the answer. It won't always be a black and white answer.
Absolutely.
Okay. That same survey I referenced earlier, 25% of young participants understand how taxes may impact stock-based benefits, compared with 38% of boomers. That knowledge gap is just from being around and having dealt with these things. So you're helping to close that gap.
Absolutely.
So, okay. I love it. I think that's great. What do you think is the biggest misunderstanding when it comes to being paid in stock by a startup company. I think most people, the big thing they understand is that they're taking a risk. Instead of cash today, you're accepting a piece of paper based on how well the company does. And if they're your employer already, it's almost like a double risk.
Absolutely.
Okay. So, but I think everyone gets that. What are some of the other big misunderstandings that people maybe don't get that easily on the surface?
Well, one thing, that's a great question. And one thing I'd like to see change is really the post-termination extended exercise windows.
I don't know what any of those things are.
For the past 15 to 20 years or so, essentially the standard post-termination exercise window and high exercise costs have sort of made stock options be viewed as, golden handcuffs, if you will. That exercise window is essentially a period when a person is leaving a company, they can buy shares at the exercise price outlined in their compensation package. But for most employees, that means that if you were to leave or a company asked you to leave, you only have 90 days to then exercise those vested stock options. And so that forces employees to exercise those options within that 90-day window.
When you say exercise, they have to put the money up.
Right. Exercise, meaning that they have to have the upfront cash to buy the shares. If they don't, they end up losing them, the stock options, essentially losing the equity comp benefit. And so that favors people who are already wealthy, who can afford to shell out thousands of dollars for an asset that, they could very well be locked up from selling for years. And, I think that there are some companies that recognize this burden to younger employees or employees who, come from disadvantaged backgrounds where, they may have to help out family with certain things and they may not have that extra cash flow to take advantage of this, especially in the 90-day window.
So what do? Those companies that have a conscience?
Some companies are actually extending that window from 90 days to 7 years and even 10 years. And so I think that goes to show options aren't perfect. There are certain people that benefit more from it than others for reasons I just explained. And I do like that there are companies that are recognizing this burden and they're, doing things to benefit their employees in the long run, even if they're no longer employed at that particular company.
Okay. So, Sam, you're a financial advisor and you happen to have this specialty, which I think makes you somewhat unique in our space because I think a lot of financial advisors meet clients that might have these types of issues, but they don't necessarily have all the right answers, but they'll still take on the client. How are people finding you and your services? Because I think you do a really good job of explaining what the issues are.
So far, I would say it's been social media, word of mouth, and I've recently been speaking at tech companies. So a lot of tech companies have these things called employee resource groups where, they may have all of the Black employees at a company get together and form an employee resource group where, they pretty much just support one another. They have certain events and provide resources for each other. And one of the things that I've been proactive with is trying to get in there and speaking to the Black ERG groups and informing them about, equity compensation. So many people have trouble just aligning their 401ks with their retirement goals. Imagine, a 25-year-old coming out of grad school getting, a couple tens of thousands of equity compensation, and the tax consequences that supplement that. And I think that's extremely important to focus on.
I agree. So it's great to have somebody like you out there that can explain these concepts to people. I hope more people hear of you, and hopefully this conversation will be seen by people who are in search of answers to things like this. Sam Deane's your guy. He has the answers. How do you want people who watch this to follow you? So
my website is deanefinancial.com. That's DEANE. And my social media handles, Twitter and LinkedIn and Instagram is Samuel S. Deane.
Awesome. All right. Well, thanks for coming on. We're going to have you back for sure. This is a big topic. If you have questions on equity-based comp, reach out to Mr. Deane. He's got your answers. Let us know what you guys think about stock options, equity comp, the knowledge gap. We want to hear all of your thoughts and opinions. Leave them below. Go ahead and follow the channel if you haven't already. Give us a like. Doesn't cost you anything. Those really help us too. And we'll be back very soon.